Welcome back, traders and investors. We have a very special guest on the line today, Dr. Marc Faber, author of the Gloom, Doom, and Boom Report. Dr. Faber, how are you doing this morning?
Everything is fine. Thank you very much. It's evening time in Asia.
Evening time in Asia, and you're in Thailand right now, correct?
Yes, correct.
Okay. Well, let's get right into it here. You're looking at tech stocks, and you think that they're more overvalued than they were in 2000. Are there any ones in particular that you're looking at?
Well, I think it's always difficult to make comparisons, but a lot of tech stocks in the social media space are probably overvalued. And then we have tech stocks in cloud computing that, in my opinion, will come under a lot of competitive pressure. And so the outlook is maybe not as favorable as investors seem to think. In general, new industries, they go through a bubble phase, and then there is a massive shakeout. It's a little bit like in mining. You have lots of exploration companies, and at the end, maybe 5% maximum of the exploration companies do well. And the same applies to biotech and to new industries such as technologies, new technologies. Most of the companies eventually fade by the wayside, and there are just a few survivors.
And what kind of metrics are you using to make these determinations?
I beg your pardon?
How do you evaluate these stocks? What metrics do you use? Are you looking at PEs? Are you looking at?
Well, I look mostly in terms of values among stocks, and I'm rather, let's say, hardcore value investor. I look at price to sales, dividend yields, price to book, and so forth. Of course, if you look at new technologies, if you had just invested based on dividend yields of price to sales, you would have missed a lot of stocks. At the same time, you would also have avoided great disasters. So I think it depends a bit. Different people have different strategies.
Do you think this bubble's going to burst anytime soon? Because obviously we know bubbles can get bigger and bigger and bigger, and it's the timing that is critical if you're looking at playing these from the short side. Do you think this bubble in the tech stocks and some of these social media stocks is ready to burst?
Yes. I mean, I'm not short at the present time tech stocks because, as you say, the bubble could get larger. But between being not short tech stocks and finding them to be attractive, there's a huge difference. I think the bubble may become bigger, and we've heard from Ms. Yellen that essentially she doesn't think that the Fed should intervene in bubbles with monetary policies. In other words, if a bubble develops, the Fed will let it go, let it happen, as they did with the tech bubble in 2000, with the housing bubble in 2007, when Ms. Yellen was presiding over the San Francisco Fed, which was in charge of California, Arizona, Nevada, essentially the states with the biggest housing bubbles. That is her merit. That is her qualification to be Fed chairman. So I think it's a tough decision. But I believe as an investor, sometimes it is better to say no and stay aside than to take the risk and then have huge losses, as occurred after 2000 in the tech space or after 2007 in housing-related stocks, in government-sponsored enterprises like Fannie Mae and Freddie Mac and so forth.
And how would you play it when you feel that the bubble is about to burst? Do you outright like to short the equities? Do you use the futures markets to short the broad market?
I would outright short equities. But I think there are also opportunities in some long-dated puts, because the put premiums are sometimes very low, and you don't take a huge risk by buying puts. In other words, the worst that happens is the stocks don't go down, and then you lose your put premium. But as I said, I am not short at the present time, although conceptually I think that people or investors should short the Russell 2000 and probably the Nasdaq index and go long maybe some other markets.
What about the Fed, though? Because the Fed has supported this market for so long, it seems like every time it pulls back, the Fed is behind it. Obviously, they're tapering a little bit here now. Do you see that ending soon, and do you see interest rates eventually increasing here, or does Fed just continue to support this market?
Well, in my view, if interest rates go up more than the Fed would like them to go up, then I think they'd actually increase again the asset purchases. And that would be my view also if the S&P dropped by 20% or more. Then the call among conservatives and among Democrats and whoever it is would be, oh, we have to do something for the share market. And then the Fed would be actually under pressure to again increase the asset purchases. So I think the Fed will eventually be in a very difficult position.
Part of your thesis is that big government is thwarting economic growth, and you refer to the Rand curve as government spending as a percentage of GDP. And since the 1930s, it's risen from 10% to 30%. I mean, can this trend be reversed?
I find it very difficult in democracies to really cut government spending meaningfully, because what has happened over the last, say, 100 years is we've moved from a system that was individual-based, where individuals had personal responsibility, towards an entitlement society where essentially people get health care coverage, where they have insurance coverage for just about anything, where they have social security, where they have allowances for children and food stamps and then disability benefits and so forth. And in a democracy, to take that all away is next to impossible.
The scenario that you were talking about, do you see any danger of deflation coming in then?
I'm actually surprised why everybody, including you, talk about the danger of deflation. Why don't people talk about the danger of inflation, in particular the danger of asset inflation and asset bubbles? Because the entire 19th century, before the Federal Reserve was in existence, was a century of deflation. And real per capita incomes in the U.S., in other words, what people earned on a per capita basis, went up by much more than in the 20th century when we had the Federal Reserve. In fact, I would argue that the Federal Reserve's policies have slowed down the potential of the economy meaningfully.
Okay, so the quantitative easing, in your opinion, could have been avoided or carried out in a different way?
Okay, first of all, my view is that we had LTCM in 1998, and there was a bailout by the Treasury and the Fed, and that gave a signal to Wall Street and to the financial sector: leverage up as much as you can. There's a Greenspan put, and there is a Bernanke put, that whatever happens, They will step in and bail you out. Then we had the NASDAQ bubble in 2000, which was largely a undertaking by the Federal Reserve. And thereafter we had the housing bubble, again because interest rates stayed artificially low for too long, and because even the Fed chairman, Mr. Greenspan at the time, was encouraging subprime lending. The Fed at that time could have curbed subprime lending because ultimately who is responsible for the financial system? The Federal Reserve. Now they create all these bubbles, and then the bubble bursted in 2007, 2008, and then the Fed started monetizing massively and essentially portrays themselves as having saved the system, when actually they created the crisis in the first place. So to say that, what do you think about the QE programs by the Fed? I think maybe in the situation we were in 2007, 2008, the action were useful, but useful only for a few people. I don't think that the global system, the global economic system would have collapsed if AIG and Goldman Sachs and some of these major institutions would have gone bankrupt. In fact, 90% of the global economy wouldn't have known about it or felt it at all. But the financial sector would have felt it, that's for sure.
Okay, so the next bubble will be the government debt, and we're seeing things that are going on in Argentina that are quite alarming. What about?
I think that probably will have a systemic crisis. Exactly from where it will come, we don't know, because if I knew, you would know, and everybody else would know. That's essentially the characteristic of a bubble. You never know really what the catalyst will be for the decline. Why did the NASDAQ not peak out in December 1999? Why did it peak out on March 21st, 2000, and not in May 2000 or in June 2000? We don't know. And so it's very difficult to say where the crisis will occur next. But I think sovereign debt and the artificially low interest rates on some sovereign debt, like on French government bonds, 10 years, 1.7%, that this is a good candidate.
Dr. Faber, how do investors prepare for this eventual pullback? Because we know bubbles burst. Eventually it's going to happen. Do you suggest like just getting on the sidelines right now already? Or because he could have been looking at this a couple of years ago and saying the same thing, and the market just continues to run? Or do you just continue and just be prepared because it will turn, and when it turns quickly?
Well, first of all, I think that investors, in absence of knowing how the future will look like, and that is the first thing an investor should say to himself, I can make certain predictions and certain assumptions, but in the end, I don't know how the world will look like in 3 or 5 or 10 years' time. There's so many different things that can happen in the meantime. So the best is probably to have a diversified portfolio consisting of some real estate, some equities, some bonds, and some cash, and some gold. So that gives you some protection from a major decline, because maybe some assets would rise. Certainly the value of cash would go up if there was a crash in asset markets, or certainly it would go up if there was a synchronized crash in real estate, stocks, bonds, all at the same time. Equally, I think that gold may not be entirely corrected to financial assets. So I think diversification is important. And within the global bubble that we have in asset prices, I suppose there are some markets that are relatively inexpensive compared to others. And markets and stocks that would go down less than others.
What? So you mentioned gold there. So what's your? Are you playing the gold market now? What percentage of it is your portfolio? Do you have of it in your portfolio? And are you prepared to increase it at different levels?
Well, I don't play the gold market. I have been accumulating gold since the early 1990s, and I will continue to accumulate every month some. And when gold becomes overvalued, I stop increasing the position meaningfully. And on setbacks, as we had after 2011, after September 2011, until recently, uh, at the lows around 1200, 1250, I increased my positions. And I think we had a strong rally. Nobody believes that this rally is for real. We may test again around 1250, 1260, but I think around that level I would look at gold as being at the favorable entry point. Equally, the same would go for silver and especially platinum.
Okay, so you're looking at all the metals here, and
And I have to say, I own, and you asked me about what percentage is my asset allocation in gold. It's probably between 20 and 30%, something like that.
oh, okay, that's a pretty substantial percentage
And
there.
it's physical and not stored in the United States.
Okay, and so we talk about a lot of different ways to approach the market here, and obviously you have a very strong fundamental outlook on the market. Do you pay any attention to technical analysis? Is that part of your analysis, or do you just pretty much stick to the fundamentals?
I prefer, or I'm attracted to stocks or assets that have a saucer bottom. Say, if you looked at the chart of gold between 1970 and 2000, you could see that gold had a huge run into January 1980 when it topped out at around $850 an ounce. And then we went down and we built a long-term base between the late 1980s and 1999. That I like. Similarly, there were stocks that had long bases that looked attractive to me in the space of the old economy stocks, basic stocks that people neglected at the end of the 1990s. So yes, I pay actually a lot of attention to technicals. What I like to see is a long-term base building period in an asset, and then a breakout on the upside with very high volume, and that there is subsequently a follow-through. So yes, I combined technical analysis with fundamentals, and frequently I see it, or I get an idea from looking at charts, long-term charts of different assets, and then I ask myself, well, this looks attractive on the chart. Then I'm interested to check the fundamentals. Has something changed to the favorable? Equally, if you have a parabolic rise in an asset class like stocks sometimes, or commodities are especially susceptible to parabolic rises, because at the end of a move, there's frequently a massive short squeeze. Or if there is a parabolic rise in government debt, I also become interested, and I think we have had that. So when you have these parabolic rises, we are in a bubble stage. The bubble can become much, much larger, that I concede, but it's then a stage that is dangerous to invest in. I have to say that in the last phase of bubble, you have the highest capital gain potential in the shortest period of time. As an example, between the end of 79 and January 1980, gold doubled in price. The Nasdaq 100 between October 99 and March 2000 also doubled. So you're in that last phase of the euphoric rise. They are huge profit opportunities. But each person has to have a strategy. If you always want to invest in that last stage of the bubble, you also have to be prepared to take losses very quickly. And I prefer to take a long-term, value-oriented approach, and I'm not interested to invest in bubbles.
Okay, so I guess your final advice for the average investor would be just kind of play it close to the belt here. If you're investing in some of these stocks or equities that have made big moves, just use protective stops or use puts or something to protect your assets, because when it turns,
sure.
is that
you understand with the protective stops? When the crash happened on October 19th, 1987, stocks opened down, say 15-20%.
correct?
And the Nikkei futures opened down because I was then exactly in the office. The Nikkei future had closed at something like 19,000. It opened at 10,000, the futures. And then it dropped to 9,000, and that's where a client of mine covered.
Wow. So I guess what
we stopped. If you put a market stop on the Nikkei, say at 18,000, you got executed at 10,000.
Right. So take some profits on the way up and have some downside protection on the way down. Well, Dr. Faber, thanks for coming on the show today. We have the author of the Gloom, Doom, and Boom Report giving us his cautious outlook on the market. We appreciate you coming on today, and certainly like to have you on again.
Thank you very much for having me.
Okay. Have a good
Goodbye. Thank you.
Have a good day.
Bye.